Ever wish you could sell a property, make a huge profit, and give exactly $0 to the IRS right away? That's a tax swap, officially known as a 1031 exchange, named after Section 1031 of the Internal Revenue Code. Here's how powerful this is. Instead of losing 20 to 30% of your profit to capital gains taxes, you roll 100% of that money into your next investment. And there's no limit on how many times you can do it. The biggest real estate empires in this country were built deal by deal using this exact tool. Our job at Remote LO is to help investors fund that next bigger step in their portfolio. Let's make sure you know this inside and out. The first rule of a 1031 exchange is that the swap has to be like kind. But don't let that term throw you off. It doesn't mean you have to swap one type of property for the exact same type. You can trade a dusty old warehouse for a shiny new apartment complex. You can swap vacant land for an office building or a single rental house for a retail strip center. As long as both properties are held for investment or business use, the IRS is happy. The one thing that doesn't qualify is personal use property. Your primary residence or a vacation home you use yourself won't fly. The simple rule to remember: investment property in, investment property out. There are two clocks your client absolutely cannot ignore, and the first one starts ticking the moment they sell. From the day the old property closes, they have exactly 45 calendar days to identify their next property. And this isn't a handshake deal. It has to be in writing, delivered to the qualified intermediary. They can identify up to 3 potential replacement properties to give themselves options. Here's what you need to drill into every client. Miss this deadline by even one single day, and the tax-free status disappears permanently. There are no extensions under federal law, no exceptions, no excuses. As their loan officer, it's your job to know this deadline and stay on top of it from day one. The second clock is the 180-day closing clock, and it runs at the same time as the 45-day clock, not after it. From the day the original property sold, your client has 180 calendar days to fully close on the replacement property. One important detail that catches people off guard: if their tax return is due before the 180 days are up, that tax return due date becomes the deadline, whichever comes first. Miss it by one day, and the IRS is coming for every dollar of that capital gains tax immediately. No extensions, no grace period. This is why, as their loan officer, you need to build the entire loan timeline around this deadline. We work backward from day 180, not the other way around. This is the piece that trips people up the most, so pay close attention. Your client cannot touch the money from the sale. Not for a day, not for an hour. If even $1 passes through their hands, the IRS considers it constructive receipt, and the entire tax benefit evaporates instantly. This is exactly why a qualified intermediary, what we call the safekeeper, is mandatory in every single 1031 exchange. The QI holds the sale proceeds in a restricted account and only releases them when it's time to close on the replacement property. They must be set up before the original property closes. You can't add them after the fact. And they can't be someone close to the client. No attorneys, accountants, or family members. Our job as the loan officer is to coordinate directly with the QI to make sure those funds are wired from the exchange account straight to the closing agent, never to the borrower. So why do serious investors use this tool over and over again? Because the math is undeniable. Without a 1031 exchange, every time an investor sells a property, they lose 20 to 30% of their profit to capital gains taxes. With it, 100% of that money stays in play, and it compounds. Each tax-deferred trade builds more equity to put into the next deal. Investors go from a single rental house to a multifamily building to a commercial portfolio, all without writing a check to the IRS along the way. Here's a bonus that most people don't know. If the investor holds properties until death, their heirs receive a step-up in basis, which can wipe out the deferred tax liability entirely. This is how small landlords become major players, and it's available to every investor we work with. So where does Remote LO fit in? We are the engine that makes the trade-up happen. When an investor is ready to close on their replacement property, they need a loan officer who understands the 1031 process. And that's us. A few things we need to get right every time. First, the replacement property must be equal to or greater in value than the property sold. Otherwise, taxes kick in on the difference. Second, the new mortgage needs to be at least as large as the one paid off on the old property. Third, the same legal entity that sold the original property must be the one buying the new one. Vesting has to match exactly. And critically, the down payment comes from the QI's exchange account, not from the borrower's bank account. We coordinate those wiring instructions carefully. Remember, we are always working against the 180-day clock. Our pitch to every investor client: let Remote LO help you fund your next empire-building move.